Well, the market started off the week really poorly, and then was finishing the week just fine. In fact, still ended up finishing the week better than how it opened. But then that's a contradiction today. We started off the day very well until and to the point where we were actually green for the week on the S&P 500, slightly green, but we had turned green for the week on the S&P 500, and then the tariff announcements came out, and then that had its impact. So we're going to break down the impact that this close to the week has had from what would have been a very, very positive close on a lot of different indicators to changing things from a short-term picture into a negative, into a more intermediate-term picture. We'll break all that down in today's video. There is one pretty significant red flag that not a lot of people are talking about. A lot of people talk about this company, but they don't talk about the technical signs that are showing up on this stock that's turning out potentially to be a significant red flag for the broader market as a whole. In fact, our trade idea of the day is actually going to be on that particular stock as well, considering how the pattern that it showed this week here after it started Monday, and then ultimately how it ended up finishing the week. So a big red flag. This has been an interesting market, but the breadth, I'm going to show you how the breadth has been deteriorating here over the past few days into today, and how the breadth really deteriorated there, and what impact that might have, and when we have seen this type of trade before on a macro level, and what pattern, how the market behaved afterwards. So we'll break all that down in today's video. Like I said, with our trade idea today, with what I believe is the canary in the coal mine for the broader market. So let's go ahead and get started. Today is Friday, January the 31st, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content, between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades to see whether we should stay in them or get out of them. Come down here to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab, hit that like button, right there. Again, the more you do that, it helps get our content out to all of our followers on these platforms, so thank you to those who do this day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we ended up down. We had a great day going, and then finished obviously lower once the tariffs were announced. The intermediate line crossing, still crossing. It was on its way down as it was, but today crossing below the 80th percentile, hence the light pink shading. The moving average dropped, so hence the yellow line. We're above a falling moving average, hence the yellow line. The near-term line fell out of bullish territory. So, this would be a bearish peak on the near-term line if we continue lower, which you expect that we will, because the momentum line is oversold, right? This is day one of us crossing below 60, and your momentum line is oversold. The expectation is that we'll probably cross further down below 40 into bearish territory. So pretty bearish near-term pattern. We were talking about the prospects of a bearish near-term peak going into yesterday. We finished not so well after coming off the highs, even that slightly. Kept the near-term line from crossing above the 80th percentile and crossing above the intermediate line. It's still below the intermediate line, and it's, now everything's falling, right? So the expectation is the near-term line will also fall down, at least in the bearish territory. The near-term line's not that oversold. Remember, the 5th percentile is the extreme here, not the 10th, even though we're sitting right pretty much on the 10th percentile. Different than the upside, where the 90th is an extreme, because it takes more to be extreme to the downside, right, than it does to the upside. But we are, that is bearish near-term pattern, and the prospects of this being a bearish near-term peak are very high. Obviously it would be a lower high, and it would be below the 80th percentile. So that's bearish, and the question then would be, are we going to follow it up with a bullish near-term low or a bearish one? Obviously the near-term line crossing below the 20th percentile would be bearish. Now, I would have raised the odds for that if we had already dropped below the 50th and maybe even the 40th percentiles today on the near-term line, but that didn't happen. But the near-term momentum line is down here, So there's still a pretty decent chance the near-term line can drop below the 20th percentile, at least dropping into bearish levels and producing a low point, right? And the question again would that be if you take this out as a potential low, bullish low, even if you do count that as a bullish low point, it would be much lower than that. And now we'd be putting in these bull tag lows into the equation, right? And definitely back below the bear tag low point, like nullifying this breakout, this building that we've had on top of it, this dark green shading and green line. You notice we never did get above the 2.5% mark, which kind of solidifies a bullish trend by getting up to that 2.5% mark and staying there. That kind of solidifies that, even with a pullback, solidifies that bullish trend. And so we'll see if that ends up happening on this go around or not. Of course, the big driver of this lately has been the NASDAQ 100. Again, a bearish near-term peak. Did get above the 80th percentile, but just barely, and already back below 60. Bearish momentum line there suggests that, it didn't, barely below the 60th percentile. So we'll see how things play out Monday. The intermediate line had crossed below market sentiment. Remember, the S&P is still above it. So we've already got that crossover there. In fact, we're almost back below the 50th percentile. Like, we're that close to having dark pink shading again. And of course, if we were to close below this falling moving average, it'd be back to a red line too, since it's still falling there. The Dow Jones, remember, got the cluster. So the Dow Jones Industrial Average here this week, early this week, at the very beginning of the week here on Monday and then on Tuesday, had overbought clusters. So very different pattern than what we saw on the NASDAQ and the S&P. That had the big gaps to the downside. The Dow also gapped to the downside, but finished with a gain. Like I said, finished with clusters. But then a little bit of an engulfing pattern here to finish off the week, down 0.75%. The near-term line did cross below 60 and 40, both of those, and the momentum line is way in the oversold level. So that is a very bearish pattern, suggesting that the likelihood of this, we've had a really good bullish near-term run, but this would suggest the likelihood of a bearish near-term low point set. Now, granted, the last near-term low was down here, so that's a long ways to go to even get to an equal low point. But this is not the kind of pattern that would suggest that we're going to bounce off of a new bullish low point here. And so, again, it puts into question kind of how we might start on Monday. And, of course, if tariffs change over the weekend, right, then things will change on Monday, as that typically happens. Let's take a look at the Russell 2000. The Russell didn't have a good day at all today. It still has not been able to build on that bear tag it got from a couple weeks ago, right after expiration. The near-term line didn't even get into bullish territory, much less the upper reversal zone, so really bearish. Hasn't fell down yet, but still below the intermediate line. The intermediate line is actually still above market sentiment, but the near-term line never did get above it, and now we have an oversold momentum line. So unlikely that near-term line is going to make it to above 80. So things aren't looking, on the short-term basis, things aren't looking too good. Even if the intermediate line is still rising and still dark green shading, and the last near-term lows were pretty low for most of these indexes. It's not looking too good for the near-term basis as we head into a new week and another week of a lot of earnings announcements on tap. Let's take a look at the weekly chart. This also does not look too good either. Like when you look at how the week ended, a much lower Hakinyashi close. I was kind of trying to draw here. Here, let me remove that. I was trying to draw the what potentially could happen in class today with next week's candle. So next week's candle will open up right around a little bit over 6,000. Right, it's the midpoint of this body is where the next week's Hakinyashi candle. We're trading at 60.40 right now, right, which is actually above this week's Hakinyashi close. So the body will be about the same size because it's about right there. So that's about the size of the body, assuming we don't gap down or gap up for that matter. If we open up on Monday, the Hakinyashi body will be a little bit bigger, and the close will be higher than this week's close. But you can see we'll be well below this high point. So we'll be set up for, we were setting ourselves up for a pretty decent candle when we were trading up here closer to 6,100. But that drop down to 60.40 has set us up for a less than bullish candle next week, because this is a transition as it is. And if we get another bearish candle like something like this next week, kind of a transition, but but again, more bearish, then that's not what we want to see. So not a good finish. You can see the size of the candles dropping below the 3-period average, and the PPO is still falling. If I look at the weekly chart on the market forecast as well, you can see here that like we did get a cluster last week, and there's this week's candle, the actual candle for this week. The momentum line dropping, the near term line still in bullish levels, so coming after this cluster. So we're not like threatening here any kind of major downside decline, but not looking really good either. Could have been a lot better. Okay, we could have finished a lot better had we finished near the highs of the day today. When you look at the 3 green arrow chart, you see the engulfing pattern there on the S&P, as well as the NASDAQ 100 for that matter, giving us, we still have 3 green arrows. The NASDAQ, of course, has the 1 red arrow. We have 3 green arrows over here. So again, we're not bearish right now. It's just that we might be kind of on the tipping point. We're still above the 17-day moving average, barely below the 8. The MACD is above its moving average. The histogram hasn't turned negative yet. So, again, we're not on a decline. We're just not as bullish as we could have had we finished higher. We're not as bullish as we could have been. The DMI obviously changed for the worse as well. We're still above 30 on the positive indicator, but we're not, like, we were much lower on the negative, and now we kind of held up below 23, well above 20, and barely below 25 there. Looking at the RSI and the CCI, again, still at neutral levels on both of them. Neither one of them showing really strong patterns. The Ichimoku cloud, we're above the cloud. The rate of change is positive, but there's no trend going. Remember, we didn't even have a bearish trend here on the S&P, and there's no bullish trend going either, so very neutral. And then looking at the Bollinger Bands and the Keltner channels, you'll see the bandwidth is kind of peaking as we are stuck in the middle of the bandwidth. We're barely above, at least we're not in the lower half. We're barely above the midpoint, and that momentum, which had been pretty strong to the upside, is now waning to the downside with the bands themselves there outside of the Keltner channel. All right, now let's take a look at the intraday, right? And this is where things kind of like got dicey. Like, we were that close to getting new 4-week high, that close to getting the green line up to 100, and we failed. Like, we were above yesterday's high, and we got all the way down to yesterday. Now, we finished with a little bit of a pop, so that's a good sign. But look at all that volume. And this is when the tariff news got announced. Look at all that volume as we picked up at the end of the day. So a lot of bearish volume. We got all the way, like I said, all the way down to yesterday's low. A lot closer to last week's low point, or the week before the week. So obviously we're going to have a lower low and a lower high this week. But at least we closed above. But we were that close to closing to getting a slightly higher high, which would have been a really good sign, an outside week, outside pattern, outside day, like an outside period, but would have been a really good sign. So, and again, it would have been good to pop this back to 100, but now we are like perilously close to dropping it below 70. And we're not, like, when you look at the stochastic chart here in terms of where we're trading, we're still easily in bullish territory, still above the average, but not above 80 anymore, and not above 90 for that matter either, which is where we kind of want to be when you're strong. At least above 80 remain strongly bullish. And we've been below 80 multiple days this week. So things are not looking so positive from that perspective. The volume today and the range picked up. It was weak going into today, going into the end of the day. It picked up, so we ended up with an above average range and above average volume, and a lot of it negative, as I showed you. And when you look at those numbers in context, 60 million shares is way up here, and you can see the range was above. So it's making these turn back higher again. Now, one day doesn't make a trend, and we're still above moving averages, so we don't, we're not below the 30-day moving average yet. But generally speaking, we don't want these bigger ranges and bigger volume days because they're, as we saw, they're associated with negatively, not necessarily with positivity. When you look at the volatility index, it jumped up here at the end of the day, back up above the 90% mark. The VVIX jumped up back above 100 after barely closing below it yesterday. It jumped back above 100 today. The skew remains down. So when you look at the skew here, because that measures the demand for big moves, the protection against these big standard deviation moves, the skew is still, it's at 156.70 today. So it's still below the average, a little bit below where it was yesterday, but it's still below that average. So that's still like, remember, when the skew is dropping here, when it's below a moving average and falling, then usually that means the VIX is either popping or about to pop. So, again, the VIX didn't necessarily pop today, but with the VVIX above 100 and the VIX itself closing, whoops, sorry, wrong chart. With the VIX itself here closing above its 200-day moving average, barely, but closing just a smidgen above its 200-day moving average. Again, that's when the bigger moves come, right? The bigger moves don't come below the 200-day moving average. They come when you're already either right on it or above it, right? That's when the bigger moves come, these big spikes. We don't get the big spikes when you're below the 200-day. Once you get above it, now we're susceptible to these rallies here. And so this, like over here, we got right to it. Here we are again, right to it. And so, again, Monday is really important that we don't get any follow-through to what we saw in terms of how we ended the day today. All right, now let's take a look at what's driving the price action. You can see, again, like this has been a QQQ dominated 3 months. Like it's, remember how this broadening trade is supposed to be the big deal? Well, the Qs have been dominating. Like the IWM started off the period pretty strong towards the end of the year, towards really much around Thanksgiving. But then after that, it's been on the decline, whereas, from that point, and Qs have been on a rally, pretty significant rally from that point, really from 11/26 on. If I were to take a look at 11/26 of last year on to now, we'll look at like an hourly chart. There's the Qs up 3% and IWM's down 6.5%. So big divergence there, and gold also kind of matching them. I tweeted out about the strong correlation that gold's had with stocks, which is pretty crazy in and of itself because gold is typically considered a safety trade, and obviously stocks are a risk asset. But it's really interesting when the dollar is at its a lot closer to its 20-year highs than it is 20-year lows, and pretty darn close to its multi-year high, which should put pressure on gold, but hasn't been. So it's kind of interesting to see that gold and the dollar doing so well, and stocks doing so well, which when the dollar and gold are both doing well together, that's typically a sign of risk off, and yet the stocks have been doing very well. So interesting pattern for gold here, as you can see. In fact, when I look at the chart, that's a very strong move. In fact, if you look at the DMI for gold, it had gone parabolic previously, on this big jump. But here we are again, not necessarily like the positive indicator is well above 40. The ADX, of course, was so low. We had gone so sideways, with both the negative and the positive being so high there, which basically is a function. If you notice, gold pretty much gaps up almost every day. Almost every day that it rallies, it gaps up to the upside. And that's kind of why we're getting some odd patterns here with both lines being. But now your positive indicator, see, it's as high right now at 47 as it was over here when the ADX was popping. It's just your negative indicator is not so low. And we'll see ultimately, if and when that drops down, because that's a pretty strong rally that gold has been having here, along with, of course, the Qs. Of course, now remember, keep in mind that, as we talked about before, that the Qs are showing a, let's just go to the gold futures contracts. We don't see those gaps because that obviously makes a big difference. Get rid of that. Get rid of that drawing. That's a good, strong market forecast chart. And you can see it, obviously a little bit of near-term weakness, but not nearly the same as what we saw because of that big, strong breakout that we've had in the past few days. And then now let's take a look at the DMI, but we'll look at the futures contract instead of, and you can see, well above 35. The ADX is rising above 20, like strong move for gold right now. Very, very strong move for gold. And that's with a pretty decently strong, decent move for the dollar. Look at the move the dollar had today, getting back up above its rising moving average. The ADX obviously has been falling because it had been so parabolic, which generally is bearish for equities. It was not bearish for equities over the past few months. Equities have been, there's been some volatility, but it's been overall pretty decently bullish. And you can see the drop we had, but that's coming off a pretty decent bounce here for the dollar index. getting back up above all those moving averages and turning higher there on its MACD and stochastics. And then, of course, the 10-year yield, which is another function, jumping up here as well, 4.56% today, getting not above its moving averages like the dollar, but looking like it's turning up, closing above the high of the low day, like looking like it's starting to turn up there. So, and again, generally, like when yields and the dollar both rise and commodities rise, then that generally puts pressure on equities, right? That generally puts pressure on equities. And if you see like crude oil here, in a response to that tariff news, crude oil rallied, right? So it's down. You can see it's been down. It hasn't been on a bullish move. It's been on a relatively bearish move. But if it pops here and the dollar pops here and the off of these lows and yields pop off their lows, then that would be a sign of inflationary, like just what we saw in 2022, and that that was the last time that three-headed monster really put a damper on risk appetite, and we kind of see that impacting now. I think really one of the biggest factors, and I'll bring this up, and I haven't tweeted this out, so this is kind of this is something for everybody who just watches these videos. But one of the biggest factors, I believe, one of the biggest red flags that's out there right now for the market. I mean, obviously the market's still bullish, and might be some near-term weakness like we talked about, but generally the intermediate and long-term trend's still bullish. NVIDIA is breaking its 200-day moving average. We'll talk about a trade on this here at the end of the video, but it's breaking its 200-day moving average. But if I were to switch this to a weekly chart, and then change this MACD, let's get rid of the volume profile for now to make it easier to see. But then we're going to change this MACD down here to the gap between the 50 and 200-day moving averages. So not your typical MACD time frame, but the look at this gap, which is pretty large. It's not the largest it's ever been for NVIDIA, as it was going into the fourth quarter 2018, but pretty large regardless. Very, very large. But if you notice, look at that histogram. The histogram now has finally turned negative. And that's a red flag, because when NVIDIA, when its histogram turns negative, especially when, and you can see it right there, especially when the gap between the moving averages is so large, like that is a big red flag. You can see when it turns negative, it turns negative. That's a big red flag. Now, it broke the 30-week moving average for the first time in multiple years, right? It hasn't been below the 30-week moving average since early 2023. So about just over 2 years is the last time it's been below that. We're still above the 50. Breaking the 50 is when things really get dicey. And we may still, like usually when we get that first red bar, like we did right there, we were already below the 50 there in that case in 2022. In the case over here, we were not below the 50, and it took multiple months before we finally did get below the 50, and then we filled that in. And then over here, no, not this one, over here, this one, when it got below 50 again, it took about a month plus before it finally broke the 50. But it hadn't broke the 30 like it did now. Like now, we might not be below the 50, but we are breaking the 30. And I think this, more than anything else, is a sign of weakness for the markets, a big sign of longer-term weakness for the markets. So now, we can bounce right off of this. It's happened before. Not necessarily on NVIDIA, but on most, when there's such a big gap between the 50 and the 200, the 50 can act as a pretty significant support, because once it breaks, there's not very much support there. So that can act as a very significant support level. We can bounce off of that. But the stochastics is down below the 50th percentile. Like, things are not looking good just in general for NVIDIA. Like, you look at where we're at relative to the 4-week range, we're closer to the lows, we're below the average, we're in bearish territory. You look at other indicators for the stock, it's not looking so hot. And we'll take a look at more here when we look at the trade. And that will also impact XLK, right? Because it's obviously a big component of XLK, and XLK is a huge bellwether for the broader markets as a whole. And if you look at how it did today here on the weekly chart, we closed below the 17-week again. Now, we didn't close very far below it. It's the second time in the last 4 weeks we have, and we've closed a lot further below it before, and we bounced right back up. And even this time, we bounced right back up. So you know, based off a past precedent, which is the last, however many times that we've closed below it, one, 2, 3, 4, even right there, and then 5, that last one here, and you can even say 6 right there, and then, again, all the way down. So the last 6 times that we've closed below the 17-week, we have rebounded in a big way up above it. Again, now, we're getting a little bit longer, like we are below the 50-week moving average when you look at XOK relative to the markets here on this chart. And let's look at the weekly version. This is a weekly version, so let's go to let's zoom in. So here we are below the 50-week, and we're flirting with the 200-week. That's like in 2022, we didn't get to the 200-week until the very end of the correction, but we broke the 50-week up here, and we've been below the 50-week for a while. You can see the correlation, actually, which is typically very strongly positively correlated with the markets, is now pretty strongly negatively correlated with the markets. Usually when a correlation that's very typical goes in the opposite direction, that's usually a sign right before a big move occurs, which could be a big move to the upside, for all we know. But the last time that we even went slightly positive here, and even this time, both times we went negative. And this is a lot, actually did get below 0 this time and got well below 0, down to almost a 50%. So that's not a good sign. You can see the MACD breaking below its moving average. The long-term MACD here, let's change this back to 50. The long-term MACD here has already been below its average. You can see the bearish signs on all these other oscillators, the RSI breaking below 40. Those are all bearish signs on a weekly chart, no less, for the most important sector in the market right now relative to the broader market as a whole. And so it kind of gives us if you just look at the daily version of this, to kind of get an idea of what things look like right now on a more shorter term basis. We're below moving averages. We're well below the relative strength chart's well below its 50-day average. You can see we're in the lagging category still. The momentum was trying to get going, but the relative strength is still weak. We're still we're not in good positions here with XOK. This is the weekly chart. If I look at the daily, we're not in a good position in XOK. XLC and XLY are looking great, moving up to the right. All these other cyclical areas are not correlated with risk appetite, moving down to the left. Energy moving down to the left. And utility. This otherwise, aside from XOK, this would look great. Aside for staples as well, that's not good. That's one of your really important relationships here that really went parabolic is discretionary relative to staples. And you can see how high the RSI got. You can see how high the CCI got. You can see how high the ADX got. Well, it appears to be peaking. Now, we held up above the 8-day, 8-week, so far. But if you look at the daily version of this, that was on the weekly chart. The daily chart really went parabolic, and now it appears that we're really close to going negative. The MACD is almost negative. We already broke below the 8, but we're definitely converging. This is not it's looking weaker and weaker for a move, for a chart, a ratio that had gone way parabolic, right? Way parabolic. You can kind of see when that parabolic move ended right there, with that big drop on December 18th, and we've been pretty flat ever since. But ending the parabolic move that we have, and of course looking at other ratios that are similar, the Qs relative to the small cap stocks, you can see appears that we've topped there on the 18th as well, and we've been moving lower. And then IVW relative to the growth relative to the value, same thing. We peaked on the 18th. We've been lower ever since, and again flirting with weakness here after a really strong parabolic move to the upside in these kind of growth or risk appetite ratios. The breadth, of course, is not negative, but it is deteriorating. Right, it's not nearly as positive as it's been. We're down well below 35. I showed this in class today. It's very similar to what we saw at the end of 2021, where we had, kind of made an attempt to get above 500 and failed and dropped all the way below 0, and then made an attempt to get above 0 and failed. Well, here we made an attempt to get above 500 and failed, dropped below 0. Now we've made an attempt to get above 0, and we haven't failed so far, but the breadth is deteriorating. It looks like it's close to turning negative. And so if that ends up happening, then we've seen kind of what that led to. especially with the skew as high and everything else that we've been talking. All the other parallels that I've been showing you for the last however many months of how we are very similar to how we ended. We're ending 2024 in a very, very similar way to how we ended 2021. All right, and that takes us to our trade idea of the day, which is actually on NVIDIA, incidentally. And you can see again, as I've shown you, a lot of these charts are not looking so hot. Dark pink shading and a red line, the intermediate line crossing back into the lower reversal zone, bearish near-term peak, the momentum line, selling, a bearish, the possibility of a new bearish near-term low point. Obviously, the long-term chart has gone bearish, as we had a pretty significantly bearish week here with a red arrow. Not only do we close below the 10-week, but we're also flirting with closing below the 40-week, and we'll have a pretty bearish candle next week as well. It's a pretty decently sized bearish candle. The PPO falling. Obviously, we have 3 red arrows. This is a bellwether for the entire market, but you have 3 red arrows there, just to kind of give you an idea. We've had 3 red arrows for a while. For most of this past, couple of months, we've had 3 red arrows after some pretty decent trends to the upside. And obviously, when you look at the 2-line version, as I mentioned before, we're flirting with the 200-day moving average as well as the 50-week moving average. A decent gap in volume here until you get to support around $90. That will be important here in just a second. The DMI, if you take a look, the DMI is negative, right? We're above 25 on the negative indicator, below 20 on the positive. The ADX is rising from extremely low levels, so seems like we've kind of broken out from a trendless state into a trending state. You see that as well on the RSI and the CCI as we have crossed below 40 after kind of having a brief bullish trend here. Now we're in a bearish trend. The CCI dropping. It had already dropped down there, and you can see the weekly CCI. I mean, look at that. I mean, that's a big drop below minus 100 on the weekly CCI. I mean, that's the biggest weekly drop in the CCI for a very, very long time. So sentiment has dramatically shifted on NVIDIA, that's for sure, according to that particular indicator. We're below the cloud's pink, the rate of change is negative, and we don't even have a trend developed yet, a bearish trend developed. In fact, we actually still have a weak bullish trend, as odd as that seems, because of these weird gaps and this kind of dead cat bounce that we're getting. And then finally, if you look at the Bollinger Bands and the Keltner channels, you see that we closed below the band on Monday, and the bandwidth is rising pretty big. We're still in the lowest quartile of the bandwidth, and we're flirting with that lower Keltner channel. The momentum, the bands has barely got out of the Keltner channels, hence the green dots. The momentum is shifting to the downside. So what I decided to do here, not be too aggressive because the market itself hasn't turned south, but what I decided to do for February expiration, since I'm still outside of 20 days, let's go to what was a 25 delta when we put this on during the Market Outlook Live, selling that, which is well above that 100 level, right? 109, remember we talked about that level down there. 109, where the point of control is, I think it was actually at 89. 109 is way up above it, so we're perfectly fine there. But still at a pretty low delta, still pretty good return, a little bit more than a 2-to-1 reward to risk ratio for that, and once we position size for our typical $500 loss. And there's our trade for today. And that does it for today's video. So you've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching, members. Subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.